For years, confidence was one of the most powerful forces in business. Confident CEOs inspired investors. Confident forecasts lifted stock prices. Confident expansion plans signaled momentum. Markets often rewarded boldness, especially when economic conditions were supportive. But today, something has changed. In this environment, confidence alone isn't enough. We are operating in a market defined by volatility, rapid information flow, and tighter financial conditions. Interest rates have reset higher. Capital is more selective, consumers are more price-sensitive. Geopolitical and regulatory risks can surface quickly. In this climate, optimism without operational strength is fragile. Confidence must now be backed by discipline, data, and durability. The first reason confidence alone isn't enough in today's market is that investors are more skeptical. Over the past several years, markets have experienced sharp reversals driven by unexpected events. Earnings surprises, sudden demand slowdowns, and liquidity stress have reminded participants that projections can shift quickly. As a result, bold narratives are no longer accepted at face value. Investors want proof, they want stable margins, they want consistent cash flow. They want realistic guidance. Confident tone on an earnings call means little if it is not supported by measurable performance. In fact, overconfidence can backfire if expectations are missed. Markets punish gaps between words and results more harshly than cautious realism. Another reason confidence alone isn't enough is the higher cost of mistakes. When capital was abundant and borrowing costs were low, companies could recover more easily from strategic missteps. Today, debt is more expensive and refinancing risk is more visible. A single poorly timed acquisition or aggressive expansion plan can strain balance sheets quickly. In this environment, disciplined capital allocation matters more than ambitious declarations. Companies are being evaluated not just on growth potential, but on how carefully they deploy resources. Confidence without financial control can lead to overextension. Demand uncertainty also plays a role. Consumer behavior has become less predictable. Enterprise clients are scrutinizing spending decisions more closely. Forecasting accuracy has become more difficult. In such conditions, projecting strong growth without acknowledging risk can appear disconnected from reality. Businesses that thrive today combine confidence with contingency planning. They stress test revenue assumptions. They model downside scenarios. They build flexibility into operating budgets. Confidence is paired with preparation. Optimism is balanced by caution. Operational efficiency has become a stronger signal than rhetoric. Companies that streamline processes, manage costs carefully, and maintain supply chain resilience demonstrate control. That control inspires trust. It shows that leadership is not relying solely on favorable conditions, internal discipline. The market's reaction patterns reinforce this shift. Firms that consistently meet conservative expectations often outperform those that promise aggressive growth and fall short. Predictability is valued more than boldness. Stability often commands a premium over spectacle. Another dimension is transparency. In fast-moving markets, stakeholders expect clarity. Confident leadership that avoids detail or minimizes risk can appear evasive. In contrast, companies that openly discuss challenges and outline mitigation strategies tend to build credibility. Confidence is persuasive only when it is accompanied by honesty. Technology has intensified scrutiny. Real-time data, social media analysis, and constant financial reporting mean that inconsistencies are quickly identified. Leaders cannot rely on charisma alone. Performance metrics are visible. Execution gaps are amplified. There is also a cultural shift within organizations. Employees are more attentive to strategic alignment. Grand visions without clear execution plans can erode morale. Teams want direction grounded in achievable objectives. Confidence must translate into operational clarity. Importantly, confidence is still valuable. Markets respond to leadership that articulates long-term vision. Employees rally around clear purpose. Customers appreciate decisive direction. But confidence today functions best as a complement to discipline, not a substitute for it. Risk management has become central to strategic planning. Companies are holding stronger liquidity buffers, they are diversifying suppliers, they are phasing major investments rather than committing all at once. These actions reflect humility about uncertainty. They acknowledge that markets can shift quickly. Why confidence alone isn't enough in today's market comes down to one word: credibility. Confidence without evidence weakens credibility. Confidence supported by consistent execution strengthens it. In volatile conditions, credibility becomes a competitive advantage. Investors increasingly differentiate between narrative-driven growth and performance-driven growth. Narrative-driven strategies rely heavily on projections and future potential. Performance-driven strategies demonstrate progress quarter after quarter. The latter builds resilience and valuation. The broader economic backdrop reinforces this reality. Interest rates remain sensitive to inflation trends. Regulatory frameworks are evolving. Global supply chains continue to adapt. Technological disruption is accelerating. In such an environment, unpredictability is normal. Overconfidence can quickly appear disconnected from structural risks. Companies that succeed today often exhibit what could be called disciplined confidence. They articulate clear goals but anchor them in conservative assumptions. They pursue growth but maintain cost control. They innovate but stage investments. They communicate optimism while acknowledging uncertainty. This balance creates durability. When unexpected challenges arise, disciplined organizations adjust without losing stability. When opportunities appear, they have the financial strength to act. Confidence becomes sustainable rather than fragile. In previous cycles, enthusiasm alone could drive momentum. Today, markets demand substance. Executives are learning that tone must match structure. Bold messaging must align with balance sheet strength. Vision must be supported by execution. Why confidence alone isn't enough in today's market is ultimately about alignment between ambition and capability. Stakeholders want reassurance that growth plans are achievable under conservative scenarios. They want evidence that leadership understands risk. They want stability as well as aspiration. In volatile markets, optimism is appreciated but resilience is rewarded. Confidence may open the door, but discipline keeps it open. And in this environment, it is the combination of both, not confidence alone, that defines long-term success.